When the market is dipping and you see so much fear in the news, our first instinct can be to panic and sell. Let's talk about market downturns, and by the end of this video, you'll have some framework on what's worked best for people to get through them. As a quick heads up, this is for educational purposes and not financial advice. First, we need to understand this: markets move in cycles. Short term drops feel intense, but zooming out shows a pattern of tons of declines, followed by recoveries over time. Panic selling locks in losses. Many people sell when prices are already down, and then they miss the recovery period. Timing the market is harder than it looks, and given all the variables, it's basically impossible to do with any consistency. One approach people take is staying invested through the downturn. Instead of reacting emotionally, they focus on the long term direction rather than short term noise. Some continue investing consistently through the downturns. When prices are lower, the same amount buys more over time. Also known as dollar cost averaging, this can position them differently when markets eventually recover. Downturns test emotions more than strategy. Having a plan ahead of time greatly helps reduce reaction based decisions. The goal is to act intentionally, not emotionally. So when the markets get crazy, you can stick to your plan. Markets don't stay down forever. When we zoom out long enough, the market has steadily gone up. Recoveries happen as history has shown, but not on a predictable schedule. Staying positioned is how people aim to benefit when that shift happens. Remember, clarity beats panic. Build a plan and stick to it. Subscribe for more simple breakdowns to help you think clearly about money. Thanks for watching.